What if I told you that you could learn how to invest like one of the greatest financial minds in history? A man who started with just $114 and built an empire now worth over $80 billion. Yes, we're talking about the Oracle of Omaha himself, Warren Buffett. A man who turned simple ideas, patience, and timeless wisdom into generational wealth. In this video, we're going to uncover 10 timeless investment principles that Buffett has followed throughout his incredible career, and more importantly, how you can apply them today to build your own lasting wealth. So, grab a notebook, because this isn't just financial hype. This is a masterclass in money from one of the smartest investors who ever lived. Before we dive into his investing secrets, let's rewind to the early days of a young, ambitious Warren Buffett. As a boy, Warren wasn't just sitting around waiting for luck to strike. He was a hustler, through and through. He'd buy 6 packs of Coca-Cola for 25 cents and then sell each bottle individually for 5 cents, pocketing a neat little profit every single time. He sold newspapers door to door, delivered magazines, and even collected used golf balls from the local course, cleaning them up and reselling them to players. This entrepreneurial spirit was in his blood. At just 11 years old, Warren took all the money he had saved up a grand total of $114 and bought stock in a company called Cities Service Preferred. He watched the stock closely, and when it went up a little, he sold it, making a small profit. But soon after, the stock skyrocketed. It was then he learned one of his first, and most important, lessons. The stock market rewards patience. That single experience was the spark that ignited a lifetime of financial mastery. Now for lesson number 1, and it as perhaps Buffett's most famous quote: "Never invest in a business you cannot understand." When Buffett analyzes a company, he starts with the basics. He doesn't chase complicated tech trends or get swept up in the latest market hype. He values clarity over complexity. His rule is simple: if you can't explain how a company makes money, what its competitive advantages are, or what its long-term future looks like, then you don't invest. It's as straightforward as that. Buffett once said that risk comes from not knowing what you're doing. So, before you put a single dollar on the line, study the company like you're considering buying the entire business. Ask yourself, do I truly understand its business model? Does it have a history of consistent profits? Does it have an edge that competitors can't easily replicate? If you can't answer yes to these questions with confidence, it's time to walk away. This brings us to lesson number 2, the incredible power of patience. Warren Buffett is not a day trader. He doesn't get rattled when the market crashes, nor does he jump on the bandwagon when everyone else is getting greedy. He famously said, "The stock market is a device for transferring money from the impatient to the patient." In the short term, markets can be driven by emotion and fear. But over the long term, they tend to reflect the true value of the underlying businesses. While others are frantically chasing the next hot stock, Buffett is quietly buying great companies and holding on to them for decades. Just think about this. Buffett first bought shares in Coca-Cola back in the 1980s, and his company, Berkshire Hathaway, still holds them today, earning billions in dividends alone. That's the compounding magic of patience. Next up, lesson number 3, buy businesses, not stocks. Buffett doesn't see stocks as just little ticker symbols flashing on a screen. He sees them as what they truly are: ownership stakes in real operating businesses. Before he ever makes a purchase, he asks himself a crucial question: if I had enough money to buy 100% of this company, would I be proud to own and run it? When he buys shares, he's not just speculating on a price movement. He's investing in the company's future productivity. He's always asking, will this company still be around and profitable in 10, 20, or even 30 years? If you can't clearly envision the business thriving far into the future, then it's probably not a worthy investment. Lesson number 4 is a big one. Ignore the noise. The world is filled with financial noise. You've got news anchors shouting predictions, pundits offering expert analysis, and maybe even a friend or family member with a hot stock tip. Buffett's strategy: he ignores it all. He doesn't waste his time listening to market predictions or panicking when stocks take a temporary dip. He once wrote, "Games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard." For an investor, the playing field is the business itself, its health, its management, its competitive position. The scoreboard is just the day-to-day stock price. So, resist the urge to check your portfolio every hour. Focus on the quality of your investments, not their fluctuating prices. Now for one of his most powerful principles. Lesson number 5. Be fearful when others are greedy, and greedy when others are fearful. During times of financial crisis, when the market is in a free fall, most people panic and sell. Buffett does the exact opposite. When markets crash, he sees a massive opportunity. When others are running away from the fire, he walks in calmly with a bucket of cash. That's precisely how he was able to buy stakes in fantastic companies like Goldman Sachs and American Express at bargain prices during major market downturns and made billions as they inevitably recovered. The lesson here is to always have some cash reserves ready for those moments when everyone else is panicking. That's when true fortunes are made. Lesson number 6 is short and simple. Avoid debt like the plague. Buffett has a golden rule about borrowing money: just don't do it. Debt creates immense pressure. It limits your options, and it can make you a slave to interest payments. Even when his company acquires entire businesses, Buffett prefers to use cash rather than borrowed money. He once said, "If you're smart, you don't need debt. If you're dumb, you have no business using it." So, before you even think about investing, make it a priority to pay off any high-interest debt you might have, like credit cards. Financial freedom is always a better bet than leverage. Let's move on to lesson number 7. Choose the right people. Warren Buffett doesn't just invest in businesses. He invests in the people running them. When he's evaluating a company, one of the first things he looks at is the management team. He asks, are they honest? Are they competent? Do they make smart decisions for the long-term health of the business, even when no one is watching? He knows that a fantastic product can easily fail under bad leadership. But even an average business can thrive with a strong, ethical management team at the helm. So, before you invest, look beyond the spreadsheets and financial reports. Take a close look at the people running the show. Lesson number 8 is a principle that governs his entire philosophy. Keep it simple. Buffett often calls his investment approach simple, but not easy. He doesn't invest in things he doesn't understand, like complex derivatives, short-term speculation, or high-tech fads. Instead, he focuses on what he calls his circle of competence. This simply means sticking to what you know and having the humility to ignore what you don't. You don't need to be able to predict the future of every industry to make money. You just need to identify great companies trading at fair prices and then hold them long enough to let the power of compounding do all the heavy lifting for you. And that leads us perfectly into lesson number 9. Think long-term. When Warren Buffett buys a stock, he's mentally prepared to hold it forever. He famously said, "Our favorite holding period is forever." He doesn't care what the market is going to do next month or even next year. He's investing in businesses that he firmly believes will still be around, still be earning profits, and still be growing 20 years from now. That's how true wealth is built, not through quick flips, but slowly, quietly, and consistently over time. Finally, before we wrap up, let's look at lesson number 10, the Buffett portfolio strategy for the average person. In his will, Buffett laid out simple instructions for the trustee managing his wife's inheritance. He advised putting 10% of the cash into short-term government bonds, and the other 90% into a very low-cost S&P 500 index fund. Why? Because he knows that most people do one thing to try and beat the market, they just need to own a piece of it. A simple, diversified low-cost index fund, held for decades, will almost certainly outperform the vast majority of professional money managers and hedge funds. The secret isn't complicated, it's consistency, patience, and time. So, let's quickly recap Warren Buffett's 10 timeless rules of investing. 1. Invest in what you understand. 2. Be patient. 3. Buy businesses, not just stocks. 4. Ignore the noise. 5. Be greedy when others are fearful. 6. Avoid debt. 7. Invest in great people. 8. Keep it simple. 9. Think long-term. And 10. Let compounding work its magic for you. Warren Buffett's incredible success isn't some form of financial wizardry. It's built on a foundation of discipline, knowledge, and time. And the best part is, anyone can follow these same fundamental steps. You can start small, stay consistent, and one day, you might just look back and realize you've built your own fortune, the Warren Buffett way. Thanks so much for watching. If you found this video valuable, please hit that like button, subscribe for more weekly content on investing and financial freedom, and drop a comment below with your favorite Buffett quote. Until next time, stay wise, stay patient, and invest smart.